We're half an hour away from the opens in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Dourlers with David Ingles.
Let's get to the top stories today. China begins its annual economic work meeting today as investors await more concrete measures to back up bold pledges on both monetary and also fiscal stimulus.
Asian stocks under pressure in the meantime. Traders gearing up for the US inflation print that could influence the Fed's thinking on a possible rate cut next week.
And a Bloomberg scoop, President Biden planning to formally block Nippon Steel's $14 billion takeover bid for US Steel on national security grounds.
All right, taking a look at the market action this morning in this session, and this is really just wait and see, essentially. We've got the US inflation print coming out later today, and that's really going to be the final piece of data that Fed officials can pore over ahead of their meeting next week. So in the meantime, you've really got just sort of sitting back and waiting for what is going to come out, because, of course, if you've got a softer print, it could really set us up for a year-end rally. A firmer one, maybe it injects just a little bit more volatility, even though strategists at Bank of America are saying this CPI print could have the least amount of market reaction going all the way back to 2021. And actually, when you take a look at what's already being priced in at this point, you've got traders that are expecting around an 80% chance of a cut when the Fed does meet next week. So ahead of that, again, as I said, really just wait and see. Some of the things we're tracking, Brent crude, for instance, we've just had some headlines dropping that the US is considering even harsher restrictions on Russia's exports of oil. And so we are just seeing it for any sort of market reaction. But Brent crude, again, fairly steady right now. Also keeping an eye on what's happening with TSMC this morning, because we had the November sales figures coming out yesterday after the bell, and we actually saw a 34% jump in November sales on the year, so really good reading when it comes to the quarterly figure. It does tell us that that AI theme still is intact into year-end, but ADRs did slip overnight, and again, you've got that market reaction at TSMC down 1.4%. What else, of course, really slipped overnight on Wall Street? Let's take a look at what happened in the Golden Dragon Index. Again, you saw that pullback. It was a little bit of profit-taking that came in, so traders sort of taking stock of what we've had so far, looking at perhaps what could be a lack of clarity, but also, again, as I say, just wanting to take some profit off the table. So you saw that retreat really coming in across the board. And changing on now, taking a look at what we're seeing in futures ahead of the day. Again, it is that big focus, Dave. What's going to come out of that Central Economic Work Conference? Yeah,
given all the commentary coming through out-of-state media, and really, I guess in many ways, massaging the mindset and expectations of these markets ahead of that crucial meeting. And as Bell was just pointing out, that we are looking at likely declines today in equity markets. And investors were quick in 8% to the upside on the Golden Dragon Index on Monday, 4% declines overnight. So you split the difference. A couple of levels to track today on the CSI 300, given the possible pullback in equity markets. 39.37 is your 50-day moving average. Maybe your next support level to watch there as well. 2% on the 30-year yield, 1.8% if this rally keeps continuing at this pace. On the 10-year, we do have a bond auction today in China. You have a 3-year 2027 bonds and also 2034 bonds. Possibly we are in the window for credit numbers, but I imagine, looking at the range of dates that comes out on Friday, happy hour time, 5 p.m. thereabouts, which really has been largely the time when they have released that data. A lot of stocks to track today. It's very busy in terms of deals and fundraising. So I think you have CATL, you have Fosun Tourism, which I think is coming back online today, and they're taking that. It's a tender offer to take the company private. More on that in a moment. You also have the likes of SenseTime and a couple of others that are actually hitting the equity markets to raise some cash. So we'll talk about all those things, of course, later on.
Yeah, really interesting how there's sort of that fundraising push into year-end. But, of course, it is that big focus coming down to the annual economic work meeting that's happening and what exactly is going to be spelled out. So let's get more on it now with our Chief North Asia correspondent, Stephen Engel. And, Steve, what are the expectations, do you think, for today?
Everything. They're expecting everything, because the Politburo earlier this week essentially laid out all the issues and set the tone that they're going to do all these different things. And that's going to be the priorities for 2025, including essentially moving to a moderately loose monetary policy. So the question there is, how far and how deep can they cut rates and have a more accommodative interest rate environment at a time, of course, when the domestic economy hasn't found its footing starting, and then there's, of course, the threat of increased tariffs that could limit exports. So they really have to move more towards spurring domestic consumption. And that was something else that they talked about in the Politburo. They talked about forcefully boosting consumption. The big question there is how. How do you increase confidence? They're not going to move to welfareism. They're not going to be doing cash handouts. Xi Jinping is not going to necessarily do that. So how do you boost confidence? It's the cart and the horse, chicken and egg, which comes first, right? So policy, well, that's why we are looking at policy. Now, they're also saying that they're going to have a more proactive fiscal policy and fiscal tools. We don't know where and what sectors are they going to prioritize. This year, they prioritized Xi Jinping's new three. So that was solar panels, EVs, and batteries. But those are areas that its trading partners have singled out as being, having overcapacity. And there is overcapacity, and there's profitability issues in the EVs. So will they move more fiscal stimulus towards consumption side to, again, prioritize different sectors rather than those new three? Economic reforms, they talked about those. And they also said there'll be some iconic economic reforms. Which ones? We don't know. So that's why there's a little bit of a pause right now as far as, okay, there's lots of pledges, but let's see the details, right? That's what the Economic Work Conference, which convenes today, probably concludes tomorrow behind closed doors in Beijing. They are taking the marching orders from the top party brass in the Politburo, the top 24 officials, including Xi Jinping, and they are going to start putting an agenda to it that will be approved at the National People's Congress in March.
You know, I just did a word count on my Bloomberg on the number of times vows came up, China vows to do this and that.
Yes.
The reason I bring that up is not because of marriage or anything. Sorry, just crossed my randomly as well. Promise fatigue. Markets tend to rally on these big headlines when you get the State Council saying or Xinhua saying they vowed to do this. Markets have pulled back. How real, though? How different does this one feel to you, Steve?
Yeah, well, this is the problem when you have markets expecting certain details and the Chinese government by nature is opaque in its ability and willingness to give details. They will talk
by design as well.
By design. They'll talk in broader brushstrokes. It gives them lots of leeway to do whatever they want, basically at the time of need, right? And there's great uncertainty over the next couple of months with Donald Trump coming into the White House in a little over a month from now and his threat of tariffs of 60% across the board. There is still possible room for negotiating those down. So you don't want to throw all your fiscal shoot all your arrows, if you will, right now until you know exactly where you need to target. So, again, that's why there's been this promise fatigue, and the markets had fatigue yesterday. Investors did. All the markets, Hang Seng Index, HSCI, the H-share index, the Shanghai Shenzhen Composite, CSI 300, all shot up by 3% at the open yesterday. What happened by the end? We had it up on the screen. Hang Seng Index, HSCI, both closed lower. We also had a complete pullback of the Golden Dragon Index overnight. 8% up yesterday. What happened overnight? Down more than 4%. Yes, there's some profit taking. Yes, there's uncertainty over what the inflation print will be out of the United States. But still, you can see there's some promise fatigue by investors. We've heard this before. September, stimulus came out, big rally, huge rally. Then it petered out. Third plenum came along. There was a rally, petered out. Politburo, same thing. Now Central Economic Work Conference. We probably have to wait till the National People's Congress in March to get some true details.
Yeah. Steve, well, here's what I at least say. At least the group is listening to everything that comes out of China these days. And there's a bigger group as well, fairly more receptive. Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent. Let's bring in Stephanie Leung, Chief Investment Officer at digital investment platform StashAway, for their take, really, on these markets. Are investors and markets right to be guarded and cautious still?
Yeah, I guess, from our observation, like most people are still kind of cashed up. Dividend cash yields, although they've been coming down, is still kind of high from a historical point of view. And I think pre-election, there has indeed been quite a bit of uncertainty. Indeed, when we look at the economic data, it actually reflects in sort of, for example, PMIs that we track. Indeed, in the past few months, PMIs have been tracking lower. We've seen some kind of, slight improvements in the November data. I think there is kind of optimism within businesses that things are going to pick up next year. And that's quite across the board, right? Not just in the U.S., but also in China, where manufacturing has been quite slow. The recent PMI has been above 50 for the first time for the past few months. So I think there's a bit of optimism brewing in these sort of more forward-looking surveys. Now, in terms of investor positioning, I think obviously when we look at different markets, these are quite different. U.S. is actually, has been receiving most of the inflows so far in the past 2 years, and it continues to do so. And that's not kind of unsupported by fundamentals, right? If you look at U.S. companies, the U.S. mega caps have been making 30% year-to-year earnings growth in the last 12 months. And rest of the world has been sort of like single digit, or even in the case of China, like almost no earnings growth. So I think investors were right in putting where the money is. But going forward next year, is that going to stay still? I think that's a big question mark.
Then, if you're sort of saying that perhaps we won't see that continued US exceptionalism, or you just think that maybe the relative attractiveness builds for other markets. Which markets do you think in particular?
So, yeah, I think one of the themes that has been playing out since the Trump election is a bit of a rotation, right? Like, for example, if we start from within the US, a bit of rotation away from kind of the big caps to smaller caps, from tech to other sectors. Although I think still very, very early days, so there has been kind of no significant breakout, and tech still continues to lead. I think if you look forward to next year, there's quite a lot of optimism about the Trump policies that are pro-deregulation, that are sort of pro-business. That could spur smaller business optimism for next year, and that could trigger a rotation, because indeed, if you look at valuations, the tech companies are quite overstretched, whereas, the rest of the S&P is actually, still has some room for catch-up. In terms of global markets, I think clearly, the global markets are trading at a discount to the U.S. So we talked about China just now. I think if you look at China from a PE perspective, Chinese equities are trading at around like 10.5 times. This is slightly below their kind of historical average, so I think there's a bit of catch-up. However, I think the key still lies in earnings. And if what we've seen in terms of the PMI recovery has been will be going on for the next few months, then I think there is a cyclical recovery going on globally that could kind of trigger a catch-up for the rest of the world versus U.S.
Yeah, you mentioned a lot of things there. There's a rotation within the U.S., and I think the question right now is will there be a massive rotation out of the U.S.? And in other words, do you see any strong case or arguable case?
Yes.
To be slightly underweight U.S. equities right now, if you're a global investor?
Yes. So I think the biggest theme, of course, is Trump getting into his presidency, what he's going to do in the first 100 days of his office. And we've heard a lot of talks, right? There's the talks of DOGE, government efficiency, like getting fiscal deficit down, et cetera, et cetera. So a lot of these are sort of, pro-growth, pro-business. On the other hand, they are a bit pro-inflation as well, right? If you are, trying to spend more in terms of the stimulus, then it's inflationary. And I think more importantly, one thing that has been talked about a lot is immigration. So if you look at the median voter, and there's a survey that's done to ask people, like, what is your top kind of priority for President Trump in his first 100 days? The top priority everybody cites is inflation. That's understandable. I think that's why Trump gets elected as well. Second kind of highest priority is actually immigration. So if you think about trade, it actually rates very, very low. So I think in 100 days, the first 100 days, what the Trump administration actually have to tackle or have to show clear progress is on the top two, right? Inflation and immigration. Now, inflation is something that perhaps, Trump has a slightly lower control, but immigration is one that he has quite a bit of control. So I think the risk here is that because of popular demand, actually Trump puts out a much more aggressive immigration policy in his first 100 days. And that could be a case where, basically a tighter immigration policy pushes up inflation and also lowers growth. So I think in that sense, there could be challenges to that kind of U.S. exceptionalism case in the first half of the year.
When you say that inflation is sort of the number one priority, and actually going to that point, we had the University of Michigan survey on Friday of last week, and we saw those year-ahead expectations for CPI starting to trend higher again. What's interesting, of course, to your point, is to what plays into that. And you mentioned immigration, but trade, of course, plays into that as well. So the tariff story, how much do you think that is fully reflected in right now into markets? And also what amount of tariffs are being priced in?
Yeah, that's a great question. I think if you look at the 3-month moving average of the core PCE, it has actually been moving up for the first time since 2022. So there's a bit of like momentum already going into next year that inflation may be starting to pick up. Now, I think in terms of trade and tariffs, there's been a lot of, rhetoric from Trump, and from his first presidency, his first term, I think what we've learned is that he likes to use that as a starting point for negotiation. A lot of that may be big on the headline, but lighter on details. And I think given what you're seeing this time around, his sort of like advisors cabinet, a lot of these are business people that have international interests. So I think what we're going to see is that Trump will put out a lot of these sort of like headline numbers to use that as a starting point to negotiate with his trading partners. For example, Canada, Mexico. I mean, Trump actually wants to get something out of these two countries, and the Iran trade is actually used as a chip to negotiate. And as far as like real economic impact goes, I'm more optimistic that these impacts will be much more limited than what the market is fearing. Indeed, I don't think the market is actually putting a lot of premium onto potential trade tariff impacts. Reason being, number one, the trading partners can actually use currency to offset that. So let's say, China, for example, has started to kind of have a softer stance on its policies. Secondly, I think when you come to actual implementation of these tariffs, the U.S. has a lot of leeway as to choosing what kind of tariff they impose. For example, last time around, they stopped short of proposing tariffs on iPhone imports. And iPhones, as we all know, is sort of, one of the most important imports that the U.S. consumer will spend on. So at the end of the day, again, I think it comes back to the median voter's top concern. The voter's top concern is inflation, not tariff. And if Trump were to implement very, very aggressive tariffs, that could push up inflation, which actually is not a very, very popular policy.
Yeah.
So I think that's something to keep in mind.
Yeah, and Jay Powell might be disappointed too. Yeah.
Yeah. Well, just on that point, really, when it comes to tariffs and trading relationships, we just had some breaking news crossing that President-elect Trump is nominating Ron Johnson to serve as U.S. ambassador to Mexico. So another key relationship, of course, for the U.S. And Stephanie as well mentioned the yuan, the currency. And we've just had that fix coming through, stronger than estimate, 7.1843. But that was Stephanie Leung joining us this morning, Chief Investment Officer at digital investment platform StashAway. And still ahead, we're going to be looking at China's credit outlook for 2025 with Moody's ratings and whether geopolitical tensions do remain the key risk. It does seem to be perhaps one of the key ones that's facing corporates in China, but we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is The China Show.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
We're about 10 minutes away from the open of cash markets this morning and not seeing too much action really in futures so far, but probably better than what we had in Wall Street overnight because really it was that big pullback, a bit of profit taking perhaps, maybe a bit of promise fatigue. That's what we were discussing with Stephen Engel just a few minutes ago. But essentially what's been happening is that traders are, of course, waiting for more clarity. What are we going to get out of the Central Economic Work Conference? Also about how China is positioning in the face of Trump tariffs. The yuan reference rate, we saw that coming in much stronger than had been estimated in the survey, so 7.1843. We actually had seen the yuan also being a top gainer yesterday, but today, we're seeing fairly flat right now.
Waiting for, I would even say, inflation coming through in the U.S. later today.
Yes.
That's the other thing, too. So we might be waiting outside the wrong door today as far as catalysts are concerned. Central Economic Work Conference and, of course, the inflation print coming through. Now, on the former, so you have Chinese state media, again, sounding the warning on this rally taking place, and we'll give you a check of government bonds in a moment here. But, yeah, certainly We're starting that off with a quick look at the papers. On that very note, Shanghai Securities News says investors should beware of what it calls stampede risks in the market. And it says traders should realize that yields have much more room to go up than to fall further. Now, the paper warns of major adjustments should be a gap between policy expectations and implementation. Meanwhile, you do have the Securities Journal flagging larger interest rate and RRR cuts next year as monetary policy becomes moderately loose. The analysts tell the paper they expect the reserve requirement to fall by 50 to 100 basis points, policymakers to release as much as 3 billion yuan in liquidity as well.
And as China announces stimulus measures or measures to stimulate the economy, President Xi is projecting an image of confidence dominating state media coverage today. His remarks to the heads of different international organizations that gathered in Beijing. He told them that China will achieve this year's growth target set at around 5% and continue to be the biggest driver of the world's economic growth. Xi also pledged to manage differences with the US, saying trade wars go against the trend of history and there will be no winners. All right, that's state papers today.
Yeah, that's not optimistic. But it's a reality, right? Like, you know, the economics of trade wars are very tricky because I think you only, and I read it somewhere, I forgot where it was, that you only realize the byproducts of trade policies years down the road because it takes many years to rejig supply chains, putting up that factory, and it takes a while for, you know, for that to actually become an example of, for economic agents to act on it. But in any case, short term, we were having this conversation with our guests early on, you know, short term they might be inflationary, which is a bad problem really for markets and investors too.
Yeah, absolutely. One of the key risks there. But of course, the question of 2018 versus today, are we sort of in a better position given we already have seen a lot of supply chain decoupling going on anyway?
That's right.
That is the state of play in the bond market as well. We're tracking what's happening in the 10-year yield. We're off that 1.9% mark, but plenty more ahead. This is Bloomberg. We are just about 4 minutes away from the open of equity markets this morning, and we are seeing an absolute surge here. Fosun Tourism. Now, what's happened is they're pledging a buyback. Shares are priced at a 90% premium, I think, to where they last closed. And you've seen that reflected so far, Dave.
Yeah, the other one is, speaking of transactions here, you have SenseTime raising about close to 3 billion Hong Kong dollars in a placement. Shares are slightly down 1.4%, and a couple of other names that are also hitting these markets in terms of, well, topping the debt markets. I think you have a CGB sale, you have Tianjin selling bonds as well, and you have also share listing coming through out of RoboSense. Anyway, the open is next. This is Bloomberg.
Welcome back. You're watching The China Show. We're counting down to the open of markets this morning, and it looks like stocks could just struggle to gain a bit of traction today. We started the week with such a bang, but it's sort of already petered out, and we're just really, it's hump day.
Yeah, it is. It is. We're waiting to exhale. We have a couple of things on deck, of course, the next, 48 hours or so. So we have the Central Economic Work Conference that begins today, but arguably, to Belle's point, you know, the news has been front-loaded, given all the news out of the Politburo. The other thing, too, is you have inflation coming out of the U.S. Suffice to say, looking at market pricing along Fed Fund futures, is that I think it's 80% price for a cut next week. So we'll really need to get a nasty number to change the expectations around the Fed for next week's meeting. Going into the open today, we have a couple of other stocks to tell you about, which we'll get to in a moment. Some cash calls coming through. One specific company is getting taken private. So that stock is up about 80% in your pre-markets. More on that in a moment. Turnover actually surged yesterday to the point we were making on the front loading of activity. It's been a while since we've seen about $2 trillion in revenue in turnover. I think last time was November 12 or 13. My producers are about to tell me in my ear if I just got that correctly or not. I'll correct myself if it's the latter. The other thing we want to mention, too, as you look at trading today, is the 50-day moving average on the CSI 300. Given how that's really held up very short term as far as the uptrend is concerned, if we get a pullback today, watch it very closely. Still 4,000, though, if you'd like nice, whole, round numbers. Hong Kong in the open today, just below 21,000 on the Hang Seng Index. We're looking at Bilibili, for example, which did see quite a pullback for no obvious reason overnight, down about 8% overnight. We're down about 2.7% in the opening minutes. A couple of other things here, too. Flip the boards. We talked about this, Chosun tourism. So it's an 80% premium to the last price before it resumed trade today. It's getting taken private. At least there's a buyback of the shares that the major shareholder doesn't already own. More on that, I guess, in a moment, too. SenseTime, Prudential, the news yesterday was sources have told us that the company is looking at options for Eastspring, which is its asset manager, and RoboSense, of course, that's also a cash call there. Very quickly, CGBs, you have a 2027 and a 2034 auction coming through today. That's a look at the CGB curve on your screens.
Yeah, and actually, as the market gets underway on Wednesday, or this Wednesday in Greater China, we're watching yields and spreads more closely than usual because, as you said, we've got that auction coming up. But let's bring in Lina Choi now, Associate Managing Director at Moody's Ratings. And you've changed your outlook for non-financial companies in China for next year. So you're seeing that it's stable now. It was negative from this year. What's driving that shift?
Thank you, Annabelle and David, and thank you for having me. There are a couple of factors at play driving the change of our outlook for non-financial corporates to stable. First and foremost, of course, is the growth stimulus introduced by the government since late September. That is a very well orchestrated, quite abundantly show the resolve of Chinese government trying to support growth. And that is going to have some positive impact, credit impact in the near term to lift consumption, hopefully. And also, if you look at the second factor at play, is we are forecasting, although contract sales for the China property market, which has been in the doldrums really for a period of time now, we are still continue to forecast declines in contract sales. However, the magnitude of that decline, because potentially benefiting from this growth stimulus, could narrow going into next year. We are already seeing the October stat for contract sales. For the first month, year-over-year change is actually flattish since June 2023. So that's a pretty encouraging stat, and hopefully that will continue. Also, the new sectors, the new economic growth engines that the government is trying to cultivate. This set of stimulus package also provided, continuous support, like the new energy vehicles, the high-end manufacturing, and also clean energy. Those will continue to contribute more gradually to the economic growth. Last but not least, we are seeing continued very prudent financial discipline from most of the rated companies, especially the high IG companies. Those are going to preserve credit quality and strength for these companies in order to counter some of these could be external challenges coming in the context of Trump 2.0.
Okay, I think we know what you're talking about there, accompanied with a grin as well. I want to ask you about, actually, why don't we start, before we talk about the ratings, let's talk about property. So you mentioned early signs of stability, 1 month, first month that we see year-on-year growth. Do you have enough information on the whitelist, for example? Because that's the key here for home buyers, too, in terms of their access to funding, the other access to funding, of course.
Yeah, I think overall the stimulus package provided a couple of measures to help or to lift the funding pressure and to improve the funding access. There are a couple of measures that's aiming at increasing the volume of contract sales, reducing mortgage rates for example. Right. So I think for the sector broader as general, that would alleviate some pressure for the developers. But I think for a number of the rated, high-yield property developers, still with quite large maturity wall coming up in the next 12 to 18 months, and also they are still remaining in a relatively weak financial condition, I think refinancing risk still, will continue. for those companies.
How acute do you think that will be? If it's eased, to what degree do you see it being lessened?
I think the near term, we have already seen, onshore financing. Like we have seen a couple of developers also, was being successful in securing some near term onshore financing. But the offshore financing market, remains largely closed, really, to the financially weak developers. So, again, it really depends on a case-by-case basis.
Part of your report outlines the ratings distribution here for the issuers that you guys cover, so investment grade and speculative grade, and within that you also rank and I think we have a graphic that shows you this, the distribution in terms of the outlook. You mentioned your assumption for next year is things stabilize, earnings and the funding situation. How do you think this pie chart looks next year? The majority are rated IG, for example. Does this get substantially better? Because it already looks quite full in terms of just the BAs of your world, for example.
Yeah. If you look at the rated portfolio structure, actually 80%, like the predominantly are IG rated companies. And those include both SOE and POEs. And largely, these companies, this is the credit differentiation we've been talking about for 2 years now. SOEs or POEs, IG-rated company, first, their own financial strength, their own credit quality has been very strong anyways. Two, even throughout the last 2 years, where periodic, quite difficult offshore funding access, for example, they have had no problem in terms of funding access. So with stabilizing, although albeit a caveat is potentially at a slightly lower place in terms of the stabilization, we do think that the IG-rated companies are going to maintain their funding access and credit quality.
Are you seeing more interest from issuers to tap the bond markets? What are you seeing on the ground, for example? Because part of the exercise is to keep rates low so companies can then take advantage of those rates.
Yeah, that's an interesting question. Actually, on the onshore side of things, we have already seen quite a bit of issuance this year. As I said, onshore funding market, whether it's the bond market, whether it's the bank loans, have been quite supportive, has always been quite supportive. Interestingly, in the last 6 to 8 months, we have already seen some highly rated POEs already tapping the offshore bond market, and with also very reasonable rates.
Anything else you want to add? What else do we need to watch out for next year? Something that we haven't talked about yet. What else is important in your world?
Yeah, I think it's the downside risk that we do need to point
I was about to end on a good note. Okay, the downside risk, go ahead.
Yeah, I think the most top-of-mind near-term downside risk to our stable conditions outlook is really on the geopolitical tension side. Under a Trump 2.0, I think the tariff risk, further restrictions on access to technology could potentially slow down the development of these new growth sectors that the government has been and have been nurturing, and therefore potentially diluting the positive impact brought by the stimulus.
All right, Lina, thanks so much for your time this morning. That was Lina Choi, their Associate Managing Director at Moody's Ratings. And we're also taking a look at shares in Chosun Tourism Group. I mean, I'd have to say most likely the biggest gainer so far in the session. It'd be hard to beat 78% at this point in time. It does own the luxury resort chain Club Med. The company is proposing to buy back shares from minority investors with the aim of delisting from Hong Kong. Let's bring in Bloomberg's Asia-Pacific deals reporter Manuel Bagorian. Manuel, what's the sort of rationale behind this take private, do you think?
Annabelle, fantastic deal. Just kept us busy yesterday, and we saw a confirmed report confirmed later in the evening. Shares are flying, definitely. So the rationale is just very simple. I mean, the shares were underperforming. They've got a fantastic brand with Club Med. But, the market wasn't kind of like really fully understanding the potential value for the company, and they just decided to consolidate and take the company private. I mean, Chosun has been quite busy trying to reorganize all their portfolio companies. They were very acquisitive years ago, and they found themselves with a bit of a debt burden that they need to kind of like restructure. Now they saw Chosun Tourism as a potential company where they could take it private, buy back the minorities, and then hopefully create more value without having to, divert their attention into the disclosures of being a listed entity. So they are doing this. It's part of the broader reorganization of the whole Chosun conglomerate.
The other potential deal, I want to ask you about this. What do we know about Prudential? Because they're looking at options for eSpring.
Definitely. The different sector, David, but also a very, very active one across the globe in insurance. We're seeing asset managers consolidating, trying to gain scale, right? We've talked about other deals in the past as well in this space. They're trying to bring in more AUM. That's the fight. As you know, they are fighting with tighter fees, so they need to gain more scale. And eSpring, which is one of the biggest in Asia Pacific under Prudential, is one of those that needs to be part of that consolidation scheme. So what Prudential is trying to do is like, okay, we've got this asset with nearly 300 billion in assets under management, but we need to gain more scale. We need to diversify. We need to tap into other pockets, other strategies, and they are going to try to bring in a partner and potentially expand in other areas such as credit and perhaps get a little bit more exposure into assets in dollars, right? In U.S. denominated dollars. So they need to kind of diversify a little bit more.
Okay, Manuel, thank you so much. Manuel Baigori there with our deals team on all the latest here. It's been very busy on that front. Right, just ahead here in shows, we'll get your latest out of South Korea. It's been eventful to underscore that point here. Last couple of days or so, the latest out of South Korea, President Yoon Suk-yeol is said to prefer impeachment over resignation. Details ahead. This is Bloomberg.
Well, South Korean newspaper says President Yoon Suk-yeol would prefer impeachment over resignation. The Chosun Ilbo report cites an unidentified source within Yoon's ruling party. Our Bloomberg reporter Sohee Kim joins us now from Seoul. So this is just a story, as we keep saying, it continues to develop. So what's the latest, Sohee?
Right. In a dramatic shift, President Yoon is now said to prefer to be impeached rather than stepping down, according to local media. Well, this new stance comes after ruling party announced that they will pursue an orderly exit of Yoon, targeting a re-election in probably April or May. Well, in case Yoon voluntarily steps down, the election should be held within 2 months, like 60 days, while the impeachment process will take a couple more months since it needs a ruling from the Supreme Court that opposes the National Assembly's impeachment votes. So, yeah, he is, again, gambling his political fate with this whole entire process.
Yeah, Suhee, just very quickly here, I mean, we'll play this out, and I want to get your reaction to this. Earlier, we did hear from the Korean Metal Workers Union as they really call for the strike to then push Yoon's exit. Let's take a listen to that.
So basically, the coup collaborators are now running, or this is what he wants, to have the coup collaborators run the government, while simultaneously he still seems to be holding on to the reins of power and appointing new people to office. So this is a reason why it's very important. Democracy rests, the fundamental premise of democracy is that the power of the government derives from the people. And so by workers stepping up and showing we do not accept this arrangement, step down now.
So what do we, or what should we, let me phrase that way, what should we expect next on President Yoon's fate?
Right. So the impeachment vote last Saturday was blocked by the ruling party, and the opposition parties will soon to submit a motion to impeach Yoon today with a plan to put it on the vote this Saturday again. And what we are hearing is that unlike last time, there will be a couple more ruling party lawmakers who would join the vote for impeachment of Yoon. So it is up to ruling party lawmakers whether they would want to follow Yoon's new stance to getting getting impeached or not. So we will see the first result over this weekend.
We're seeing the Kospi rising for a second straight day. So do you think that there's a sense now that traders are sort of taking all of these political movements in their stride?
Well, we've been reporting all the changes in the market stance, but the Korean benchmark Kospi and Kosdaq have lost tens of billions of dollars so far since the martial law decree. And although we saw a technical rebound on the market yesterday, well, we expect the volatility may continue until this political situation here in Seoul settles down. And financial authorities are saying their emergency response system has been working really well, and they are pouring their all-out efforts to stabilize the market volatility. Well, they underscore the fundamental of South Korean economy is healthy, but investors are now more cautious about the level of Korean won, since any excessive move could impact sentiment around businesses and consumer spending.
Sohee Kim there, our Bloomberg reporter in Seoul for us, and you might have mentioned, you might remember us mentioning this at the start of this our Korean coverage, that the 5 families effectively dominate or hold about 60% of the entire benchmark in South Korea. And that's really the topic of the big take today, where the focus is on rich families who dominate the country are facing investors' scrutiny. So subscribers can read all about that on the terminal and also on Bloomberg.com.
Here are some of the major global stories that we're following this morning, and Bloomberg's learned that the Biden administration is weighing harsher sanctions against Russia's lucrative oil trade just weeks before Donald Trump returns to the White House. Sources say Biden's team may target some Russian oil exports as fears ease over a spike in energy costs. The outgoing administration has also moved to ramp up military and financial support to Ukraine as it prepares to depart. Israel's stepped up attacks in Syria, hitting hundreds of targets while sending troops deeper into the country. The military says it's taken out most of Syria's strategic weapons stockpiles to prevent them from falling into the hands of terrorists. Meanwhile, G7 countries say they're willing to support a new Syrian government if the transition process respects the rule of law. The suspect in the murder of the United Health Group CEO is fighting being sent to New York to face charges. That potentially sets up a long legal process. Luigi Mangione faced a court hearing in Pennsylvania where he was arrested on gun and fake ID charges. His lawyer says the 26-year-old will contest any extradition request. The judge denied Mangione bail to face court again on December 23. US President-elect Donald Trump has picked Andrew Ferguson as chair of the Federal Trade Commission. The politically charged role is currently held by Lina. Trump says his pick has a proven record of standing up to big tech censorship and freedom of speech. Ferguson is one of 2 Republicans at the 5-member Antitrust and Consumer Protection Agency.
Now, if we look at what's moving in these markets, it's very little storylines today, as I guess on the benchmark basis we are range bound, although you are getting pockets of activity like this, for example, not so much what these specific companies do in their businesses, but really what they have in common, which is really that they're Shanghai-focused equities or markets here, or stocks rather, that on the back of the city's plan that they've issued to support M&A in some key industries, including things like brokerages or securities, biomedicine, and also integrated circuits. In some cases, as you can see, we're up by the limit, the daily limit on some of these names. Watch for this very closely. The end goal here is for Shanghai to create about 10 globally competitive listed companies. That's according to this action plan by the city's government. And I think earlier background here is that I think it was yesterday that Shanghai is to set up 10 billion yuan as far as the bio industry medicine M&A fund is concerned. That's really one part of this broader story. And I guess, of course, this is really one part of the market we're tracking very closely today. Apart from this, to be honest, nothing else is happening. It's range-bound as we await for more catalysts coming through here?
Well, the big catalyst is on the horizon, really. It's US inflation print.
That's right.
It's due out later today. And yeah, as we were saying earlier, look, markets are already implying around an 80% chance of a cut next week from the Fed. So it could really take quite a bit to unseat that projection. But at the same time, if you get a softer print, it can set us up for that year-end rally. One to the firmer side, maybe it just injects a little bit more volatility. But again, as you say, pretty much range-bound at this point in time in anticipation of that. Some of the things that are standing out to us today, you still do see Korea, for instance, that's moving a bit high. So you've got the KOSPI, the KOSDAQ that are gaining for a second straight session.
Yep.
Of course, we've seen a very significant sell-off, so there's quite a bit of catch-up to play here. But even though we've got to wait really and see what happens there. Could see, again, further volatility. Australia as well, standing out to the downside, 0.6% off at this point in time.
Okay, yep, that's an equity story for now. Coming up here in shows, UBS Global Wealth put out this 72-page report, the outlook for next year. I wonder if it answers a simple question. Are stocks going to go up or down? We'll ask the question to Yifan, who joins us in a couple of minutes. We'll talk all things economics, all things markets, all things appetite, really, for risk assets among the wealthy clientele of UBS. That's just ahead. This is The China Show.
Welcome back to The China Show. Taking a look at the CSI 300 half an hour into the session, and it is range-bound, really, so far. It's been interesting to note trading volumes, because actually they're a little bit elevated still in mainland markets. Hong Kong, though, has just pulled back. So maybe that wait and see, of course, ahead of the Central Economic Work Conference. We want more policy details to come through. And you've got the US inflation print that just sort of injects that extra element of uncertainty.
0.3%, I think, is the consensus for that to come out. I mean, you'll really need a very nasty number, maybe north of 1 or 2 sigma, to just remove this rate cut that's priced in almost fully going into next week. Very quickly, too, in case you missed it, some news out of the oil markets today. And here we go. So the U.S. is actually, and this actually came out just over an hour back, is considering new sanctions as it pertains to Russian oil ahead of Donald Trump coming into office. Markets didn't really react to that. We're basically seeing a range bound as far as oil goes this week. We're up slightly, 0.5% at best across the oil contract as well. The other thing to note is down. Every so often you get an update, but down has really been the direction of travel on Chinese government bond yields. And we are getting, when you look into state media today and some of the commentary coming through, again, we've been here before a couple of months back, warning of a potential risks, one-way direction risk here as pertains to the CGB space.
Yeah, well, actually, Shanghai Security News is saying that we could be setting up or seeing a bit of a stampede, and so they're saying just be a little bit wary of that.
Yeah.
There could be more room for yields to go up rather than to fall further, and they're saying that there actually could be some sort of correction that comes through if policy implementation fails to meet expectations. That's one of the front-page items on the Shanghai Security News today. Meanwhile, the Securities Journal as well is flagging the chance of larger interest rate and RRR cuts this year.
Yep.
And that's as, again, we've had signal this week, there's going to be looser monetary policy coming through. Analysts are also saying that the paper expects the RRR to fall by 50 to 100 basis points, and that policymakers could be looking to release as much as $3 trillion. That's 3 trillion yuan of liquidity. Yuan, not dollars.
Yeah, okay.
Okay.
There's a difference of 6 or 7-fold, I
Yes.
guess. 8-fold if the bear case out of both securities comes to fruition, of course. The dollar China at 8 to the dollar, in case, of course, we get those tariffs picking up. In any case, it's just extrapolating scenarios here. In the meantime, though, you have China announcing some measures here to stimulate the economy. President Xi Jinping is projecting an image of confidence. Dominating state media coverage today are his remarks to the heads of different international organizations gathered in Beijing. Now, he told them China will achieve this year's growth targets and continue to be the biggest driver of world economic growth. Now, Xi also pledged to manage differences with the U.S., saying trade wars go against the trend of history and there will be no winners. Let's bring in Stephen Engel, our Chief North Asia correspondent, here on set with us, together with UBS Global Wealth Management Regional CIO and head of APAC Macroeconomics, Yifan, Yifan, I'll get your take in a moment, but let me just set the stage here with Steve.
Yep.
So we have this big meeting that starts today.
Yeah.
Arguably, the news was front-loaded, given the Politburo content that's come through. What expectations should we have?
Yeah, I think we got the gist of what the Central Economic Work Conference is going to be dealing with behind closed doors in Beijing today and tomorrow. Whether we're going to get some sort of detailed statement after that closes, I'm not holding my breath. There could be, they're not going to upstage the Politburo, which came out with their long list of the to-do list, obviously, to counter the slowing Chinese economy. And believe me, that was a long laundry list of promises, but not necessarily specific details. So the Politburo meeting in December generally sets the tone, and the Central Economic Work Conference annual event in December, which sets the agenda for the National People's Congress in March. So we might not get the details of the agenda setting today and tomorrow until March. So the markets don't like that. The markets want details, and we saw that with the stocks yesterday come out of the gates really hard, high, and then crept lower by the end of the day. It's because, again, there's vague statements about looser monetary policy, and you talked about that going forward. They had not shifted to that looser policy for 14 years. So that's significant, right? But just how far and how deep will interest rates and other kind of loose easing go, right? They talked about a proactive fiscal tools and policy. Where and how much? We need a number, right? That's why there's a bit of promise fatigue. Also, they're going to be forcefully injecting confidence into domestic consumption. Where? How much? When? Right? All these questions. There's going to be deeper reforms, including iconic reforms. What iconic reforms? Where? When? How? So that's why there's some question marks going forward.
So question marks, Yifan, and you've just been in Beijing, and you came back in the last couple of days. So what was sort of the sentiment when you met people on the ground, and did you feel that need from investors or traders that you were speaking to, that they do need to have greater clarity and more forceful measures?
Yeah, I just came back from Beijing, so I think the sentiment actually is getting higher comparing with the first half, especially after the September. So all the the questions Stephen mentioned remain. But I think for the foreign investors, more care about the numbers. So give me the number, although you have the framework, but they need the numbers to put their money in. But in China, I think the domestic investors, so they know the direction, so they know something coming. So I think that they are more now optimistic at the current stage. And also, I think also for the China's, currently, for the stock market, it's already rose back from 2,600, at the point now, to actually relatively stabilize around 3,300. So I think that also gives them some support, sentimentally. And also now for the recently, for the secondary market, the secondary housing market is also the trading, I think there's a recovery, especially starting from December, because they actually canceled the value-added tax. That's also some of the boost to the market. But some of the challenges remains, we mentioned about consumption, housing market. So I think that there's a still wait and see sentiment.
So what's the advice? What's the appropriate exposure now? Let me be more specific. For foreign investors who are coming in and out of this market very, very quickly, they're trading it tactically. What's the appropriate exposure now to Chinese equities? So
currently we are still remain our barbell strategy. So one side is more defensive. So it's more on the utility, financial, telecom, energy side, and also with this kind of high dividend stocks. On the other side, I think we also have to put some of the tension for the growth sectors like internet players and some of the tech sectors. So I think there's barbell strategy still at the current moment.
I'm curious as well. There's been a lot of speculation that they could raise the fiscal deficit to, 4%, from 3% to 4% of GDP. I mean, I haven't seen that number ever, really. I think since 1994 have they gone that high. Obviously, that could spur some central government bond issuances. It could create some sort of stock stabilization fund. There's more money, more liquidity out there. Do you expect that for them to raise the fiscal deficit to essentially pay for the stimulus?
Yeah, I think for the 4% from the 3% is still, of course, it's like an increase of the spending, but still, I think it's a big gap, like comparing with the fiscal stimulus. I think fiscal stimulus, in my view, and should be supported more like the bond issuance, especially for the central government. So currently, for the China central government, and their debt to GDP ratio is around 24%. So I think they still have the room to raise. For example, if in the 5 to 10 years, in my view, and the package could up to 30 to 50 trillion. So then that will increase probably about 20 to 25% of for their debt ratio. I think it's still affordable because for China's total government debt is now at the 100%, comparing with the US 120%, Japan 250%. So we still have the room to raise. But I guess we should more on the central government side rather than on the local government side, and also should be more on to boost the demand side rather than the supply side.
Okay. So to clarify, markets are looking, and I'm confused now because there's so many numbers going around. 10 trillion, and what you said is we could actually see 30 to 50 trillion. That's in total over the next 5 years?
I said 5 to 10 years.
Oh, 5 to 10 years.
Yeah. So it depends on the package because currently, if you add all the number together,
right.
And that's probably that could reach that one because we currently, for example, a housing market, I guess need 7 to 10 trillion to solve the issue, and for the debt issuance, the debt resolution maybe 50 trillion. Or we also have some for the social welfare network that's also need probably a 10 trillion additional. So I think it's all add up together. So it's in my view, it's a 30 to 50 trillion for the coming 5 to 10 years.
Okay. What do you think are going to be the sectors that authorities are going to be prioritizing this coming year? I mean, we talked about the big three, electric vehicles, batteries, and solar. Those are areas that have at least allegations of, and the people I've spoken to say there is overcapacity, and there's profitability issues as well with the EV makers. What do you think as they're trying to get more consumption-driven growth? What will be the priorities of this spending by the government this year or next year, 2025? Okay,
so for the government spending, I think for the consumption side, definitely is one of the focus. So I think but they will focus more for the long-term demand side. So I think especially they will support for the social welfare network, especially this year as for the 10 trillion for the central government transfer to the local to support the social welfare network, including this kind of elderly care. In the future, I think infant care, health care and education, that's probably will be mainly covered by the central government. So that's also needs the funds from the central government. So that's it's the more a mature social welfare network. So maybe the household is more willing to spend. And also for the short-term consumption side, I think for that trading program this year actually ran pretty well. So it's about 160 billion. So next year, I think that will probably continue. We could have another 160 billion or even higher. So, but I will not see a dramatic stimulus the package for the short term.
We've discussed this, though, in the past, that you can lead a horse to water, but you can't make it drink. And one thing that sort of stood out to me from the Politburo meeting was that they said they wanted to forcefully lift consumption. How do you forcefully lift consumption, though, if we know also that China doesn't want to resort to having welfareism and direct subsidies?
Yes, that's a very good question. I think they probably, in my view, because they always think if we give the consumption coupons could lead to some moral hazard. So I think in the policymakers' view, it's better to first it's solve their improve the social welfare network, and then we could maybe increase investment maybe on the tech sectors and some more for the investment to create more job opportunities, and then to create the more the cash flow and for the consumption. And also, I think the wealth effect is important. So that's this time also mentioned that for the stock pricing falling for the stock market and the housing market. So I think the stabilized wealth effect also could make the household more confident to spend. Actually, now households have the money because after the pandemic, we actually have the 5 trillion additional savings. So they just hold the pocket. They don't want to spend. So I think the sentiment or the confidence is more important. If they feel they can spend, so I think then they will spend.
They can keep on cutting deposit rates to get people to put the money to use, right? But what were people saying in Beijing when you were there about the Trump tariffs, the threat of it?
Actually, that's quite interesting. I think people, because in China, people think Trump is also the transactional. So I think that for the Trump administration probably will more focus on for the tariff tech transactional. So for the Chinese, think of course the tariff side we have the pressure. We will think probably that Trump announced maybe 60% of tariff, maybe for the first 2 years, maybe up to 40%. And so still have the leeway. Maybe the Chinese will purchase more. At the same time, maybe the Chinese can maybe reroute or maybe develop their factory overseas. And also, I think the Chinese thinks there's a way, maybe there's some more possibly a transaction could be negotiate with the Trump administration, even for the tech side. So I think the Chinese is willing to compromise on the trade side to probably get or postpone more constriction on the tech side.
One of the things that's come up as a function of potential tariffs is the currency weakens to offset, and whether or not that's an offset from the market or an offset from the central bank. What's the appetite right now among your clients for yuan-denominated anything at the moment? Or is the expectation is weaker currency, let's leave it in US dollars for the moment?
Yeah, currently I think that's also one of the most asked questions. So in our view, and we think that for the by year end, for the yen, for the Chinese yuan will the USD CNY will keep at 7.3. At the year end, the 2025 end will be 7.5. So have some depreciation pressure, but will not be dramatic.
Okay.
Yeah, the reason is I think that once Trump announced the tariffs, I think that for the short term, it could it's kind of the overreact, could have some overshooting, could to maybe at the short term I think it could fluctuate it maybe even over 7.5, but it will gradually stabilize. Because first, in our view, and I think that for the Chinese government will not depreciate the yuan and to support the the exports, because that's actually not something can count the tariffs impact. And also second, I think if the Chinese GDP growth can still keep around 5%. I guess that's a target. And also with the U.S. cut rates, I think the pressure actually will be less next year. So we think therefore it's still relatively stable with a small depreciation next year.
Yifan, thanks so much for coming in this morning. That was Yifan Hu, the Regional CIO and Head of APAC Macroeconomics at UBS Global Wealth Management, and Stephen Engel, of course, Chief North Asia Correspondent. Coming up, Nippon Steel in the focus this morning, poised to pursue legal action with President Biden looking to block its $14 billion takeover of US Steel, a deal that's very much become politicized throughout the election cycle. But more in our exclusive reporting ahead. This is Bloomberg.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate when your comps get tougher. How much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Welcome back. Yeah, a couple of things to note on Japan here as you look at the Japanese currency, and we are stronger to begin with and even stronger last few minutes or so. Kyodo News reporting that, and again, potentially, Japan might be looking at a 4% corporate surtax from 2026. That's to fund defense. That we know so far. We'll get you more details once, of course, we do have more certainty around that. It seems to be a story that will get more certainty, not so much over the near term. But in any case, keep that in mind. Shares from the Japanese yen, we're looking at shares of Nippon Steel in Tokyo. We're going into the last 10 minutes of trade in the morning session. Now, Bloomberg has learned that President Biden will formally block this $14 billion takeover bid for US Steel, that the American company's shares tumbled on that news. Let's go now and take it over straight to our Tokyo Bureau Chief, Isabel Reynolds, who's with us out of Tokyo. So I guess after, what's not weeks, months, Isabel, that's it. Deal's over.
Well, yes, it's been almost a year of this saga, as you point out. As it seems from now, President Biden very much plans to kill this deal by the end of the year. As we see from my colleagues, Joe Doe and Josh Wingrove in the US, they're reporting that this CFIUS report goes to President Biden on the 22nd or 23rd of December, at which point he is likely or is planning to block it. So the way forward from here looks pretty bleak, really, for the deal. As we know, President-elect Donald Trump also has expressed a very staunch opposition to the deal, so we can't really expect him to go all out to overturn this decision. And the only other option that we can see, and which is, I think, hinted at in the Nippon Steel statement on this report, is potential litigation. And I don't feel qualified to talk about how that might play out. But certainly the prospects do not look good.
What about the prospects for how the Japanese government handles this? We know that they've just been speaking about it. The Chief Cabinet Secretary, Yoshimasa Hayashi, for instance, has just been answering questions, it seems, in Tokyo. But what are we learning so far about how they might react?
Right. Well, as this is based on our own reporting at the moment, I don't expect them to have any sort of very public reaction to start with. The initial comment I saw from Hayashi was, I don't want to comment on an individual case. But what we've seen in the past is a very consistent line on this. Japan has said this decision should be based on the commercial aspects of the deal. It shouldn't be a political issue. And they've also tried to avoid linking this directly to Nippon Steel, but they've said, it's very important for Japan and the US to have these mutual economic ties. They're very staunch allies in terms of national security, so they should also be trying to bolster these economic ties, including mutual investment. And we even saw a report a couple of weeks ago from Reuters that Prime Minister Shigeru Ishiba had written to Joe Biden urging him to accept this deal. So this will be undoubtedly a huge disappointment on the Japanese side.
All right, that was Bloomberg's Tokyo Bureau Chief Isabel Reynolds there. US Steel dropping as Biden plans to block that sale to Nippon Steel. And Nippon Steel also a little bit under pressure so far in the morning session. But some of the other corporate stories that we're tracking today, and a business majority owned by Indian billionaire Gautam Adani has pulled back from a $553 million US loan deal for a port terminal project in Sri Lanka. Adani Ports and Special Economic Zone says the project will now be financed through internal accruals and capital management. Adani and other executives were indicted last month in US courts on allegations of bribery, which they deny. General Motors Cruise self-driving car unit is getting out of the robo-taxi business. The company says the decision is based on the time and resources needed to scale the business in an increasingly competitive market. Cruise and GM's technical teams will be combined into a single effort focused on autonomous and driver safety technology for future models. Bloomberg's been told that Apple is planning to bring satellite connections to its smartwatches next year, allowing users to send texts even when they're off the grid. Our sources also say a long-awaited blood pressure monitoring feature may arrive as soon as next year. Apple hopes the new features will entice hikers and health-conscious consumers into upgrading their devices. We'll have plenty more ahead. This is Bloomberg.
All right, welcome back to shows here. Interesting story here coming through. So we're looking at some quantum-related stocks, tracking really the move that we saw higher in the U.S. Well, I think the story here is Alphabet, or the Google parent, of course, announcing this major breakthrough in terms of quantum computing. And I think Bell is able to just summarize this very quickly for us. What's it going to allow quantum computers to do, Bell?
Well, essentially, it's going to. A quantum computer can solve a question or a mathematical equation, some sort of problem, in a vastly faster period than it would take a supercomputer. So it's essentially being able to compute things a lot more quickly. The question is, what do you want to do with that computing power? And that's what we're not sure just yet. TSMC as well to note, because we have seen ADRs a little bit under pressure. We've also been hearing from former Japanese government officials this morning saying that there is a risk when you've got too much power concentrated in one company. TSMC really owns the fabrication of AI chips. It's 11:29 a.m. in Tokyo this morning. Japanese markets just about to go into their break, and actually stocks are a little bit under pressure so far in the session as we do go into that lunch break. It is a little bit sort of range-bound as well, because we do have that US inflation print coming up later today. So traders are kind of also just sort of sitting and waiting for that. Something that has been maybe also weighing on sentiment is the reporting from Kyoto this morning, because they're saying that officials are looking at a 4% corporate surtax from 2026, and that's to fund to defense, because we know that Japan wants to increase its defense spending. How are they going to do it? And maybe this is one of the ways. Yeah, how are they going to fund that? Maybe that's through an increased surtax on corporate spending. As Bella was pointing out too, so we are waiting still for the key macro catalyst potentially, assuming we get something that is outside of the script. Traders are waiting for this U.S. inflation print. They're a patient bunch, aren't they? They're always waiting for something, traders. In terms of the range of forecasts here, month and month, we're looking at 0.15% all the way up to 0.35%. It looks like a fairly normal distribution here as far as that's concerned. 0.3% is the number you're looking for as far as core inflation is concerned out of the U.S. That's out in just, 12 hours from now, give or take. Right, now let's take it back to Japan now. And a lot of these domestic-oriented stocks have, in past tens, and we'll see if this lasts, though, outperformed and outpaced some of the large-cap exporters as traders are looking to, I guess, look for a hedge or shield themselves from looming Trump tariffs. Let's cross over to Tokyo, and our stocks reporter, Alice French, is there with us to talk us through this. So Alice, what are you hearing about what specific plays or sectors might win out in the event we do get sort of worst-case scenario tariffs here?
Yeah, so we're looking at basically sectors that are dependent on domestic demand as opposed to exports. So that's things like retail, it's things like domestic finance, it's things even like Oriental Land that runs theme parks here. And our data suggests that such stocks have actually outperformed exporters by around 5% since Trump won the election last month. And this is, as you say, on concerns from traders about how his planned tariffs might impact things like corporate confidence. It might slow down trade cycles across the globe. And so a lot of strategists over here in Tokyo are recommending being underweight on those big cap exporters and focusing more on domestic-focused, Japan-focused companies for 2025.
So in terms of the sectors, though, that are particularly at risk from tariffs, which ones are standing out?
So I suppose the obvious ones are automakers, car makers, Honda, Toyota, those sorts of big names. And this is particularly off the back of news that Trump is looking to raise tariffs on Mexico. A lot of Japanese car makers do have factories in Mexico. Another big risk, of course, comes to the chip sector. So semiconductor equipment makers like Tokyo Electron, Kokusai Electric that have high exposure to China. We've already seen them losing out late last month when Trump did announce that he was going to be hiking tariffs on China. So it's really the high-tech sectors and big exporters like car makers and machinery makers too that people are particularly worried about this time.
Yeah, well, the other side to that too, and let me get I wonder what how the people you talk to frame or look at this this conundrum. You get an adjustment in the currency, which tends to be weaker when we get this. But don't exporters then benefit from that? Will those upsides effectively outweigh the risks of any tariffs down the road?
Well, it's interesting you bring that up, David, because, yeah, that is quite a big dilemma, and it's something that people are talking about a lot here. But we've actually seen in the last couple of months that link between the yen and exporters actually weakening. So you're right that traditionally, a weaker yen that we've seen kind of throughout this year and in the last couple of months usually does benefit big exporters. But actually, they haven't seen such a boost from weakening in the yen against the dollar from sort of November up until now, which strategists are saying is kind of evidence that the sector is already worried about the impact of tariffs even before Trump actually becomes president. So I think we're going to see kind of a general shift within the market away from sort of this idea that, when the yen's weak, let's go for the big cap exporters. And we're going to see investors kind of trying to insulate themselves from those geopolitical and trade risks, which is good news for, retail names and local names that might not have otherwise got so much focus. So I think we're going to see a slightly new trend emerging in that sense in 2025.
Are investors using history as a guide here? What was the performance of Japanese equities under the Trump administration the first time around?
Yeah, so Japan's market as a whole did okay under Trump last time. The topics rose around 20% in the 4 years that he was in power. But if we look specifically at the impact of his tariffs, so 2018 was really the big year that Trump ramped up tariffs. We saw domestic stocks over that period rising about 7%. Compared to actually a fall of about 10% for China-exposed stocks. Specifically, this is on research from Morgan Stanley, and a much smaller rise for US-exposed stocks. So definitely traders are looking at sort of the track record that domestic stocks have in terms of showing resilience against these kind of more protectionist US trade policies. And I imagine they'll be using that as a guide for how to make decisions next year and beyond.
That was our Japan stocks reporter, Alice French, there in Tokyo. And coming up, we're going to be looking at a market not too far away, South Korea. That's where the political turmoil is turning up the heat, perhaps, on family-run conglomerates that are known as chaebols. More in our big take just ahead. This is Bloomberg.
Welcome back. Let's turn our attention now to South Korea. The Korean Metal Workers Union is staging this 4-hour strike that's today, pushing for the resignation of the President, Yoon Suk-yeol, over last week's aborted declaration of martial law, of course, a couple of hours old in total. Now, the union's international executive director, Hye-won Chung, told us why it's decided at least, to take action.
The reason for the strike is in response to what the union calls a political coup d'etat by the Yoon and the pro-Yoon forces. Also, the ruling party blocked the impeachment motion that was going through Parliament last Saturday. So workers feel that, in order to step up and preserve democracy, in order to defend workers' social and economic status, that we need to take action.
So why are you going to take action instead of, say, other workers and other associations around the world?
Well, the identity of metal workers in Korea is strongly intertwined with the building of democracy in the 1980s. So we had a long series of military dictatorships. And in the 1980s, there was the June struggle and the strikes from July, August, and September that eventually closed the military rule and opened and ushered in the era of democracy. So many sacrifices were made by workers in order to usher in the Sixth Republic, the democratic democratic republic. So when it takes a long time to build democracy, but in the blink of an eye, people who are not paying attention can find themselves under military rule again. Seeing how fragile democracy is, we are asking our members to step up to defend democracy and also to defend workers' rights. We should add, Yoon has also, among the 25 bills that were passed by Parliament that he vetoed, one was a bill called the Yellow Envelope Bill, and that was to guarantee subcontracted workers' rights. It was a bill that was put in Parliament by petition of the people after a big strike in the shipbuilding sector.
What happens if Yoon is not removed? Because right now the proceedings around the president seem very murky at best.
Yeah, so this is the second reason why we're going on strike. So what has happened is that Yoon has sort of anointed his successor to be a party, his party, and the prime minister, who was one of the cabinet members supposedly present in the decision to impose military rule. So basically, the coup collaborators are now this is what he wants, to have the coup collaborators run the government, while simultaneously he still seems to be holding on to the reins of power and appointing new people to office. So this is a reason why it's very important. Democracy rests, the fundamental premise of democracy is that the power of the government derives from the people. And so by workers stepping up and showing, we do not accept this arrangement, step down now. We do not accept someone who is, traded our democratic rule for military rule to continue to be the commander-in-chief of the armed forces. So I think either the impeachment motion on the 14th will pass, or Yoon will have to be stepped down in response to the candlelight vigil protests and the protests of workers and people.
That's Hyun Chong there, International Executive Director at the Korean Metal Workers Union, speaking with our Asia Trade co-anchor Sherry Yan. And actually, just in the last couple of minutes, we've had an update from local media. Yonhap News says that the South Korean police team are searching the presidential office. We'll have more details as those come to hand, but that is the latest we have right now. The South Korean police team searching the presidential office. Actually, on that, the potential ousting of South Korean President Yoon is likely to supercharge an investor revolt against the country's richest families, known as chaebols. They've long dominated the economy, and that is the subject of today's Big Take. Let's get more on the person behind that story. Our stocks reporter, Yoo-Kyung Lee, is joining us this morning. And Yoo-Kyung, really great investigation that you've done here, but just talk to us about the impact that these very wealthy, these very prominent families have in Korea today.
Sure. So they are probably the reason why South Korea's economy is Asia's fourth largest. They have been the engine of growth for the economy, but increasingly a lot of shareholders and investors are now seeing them as a liability for the South Korean stock market, holding back the potential that the South Korean stock market can unleash and see the rally that we have seen in rivals like peers like Taiwan or Japan. So there has been, immediately after the martial law decree, there has been concerns that the corporate reform agenda that has been pushed by the current government could be losing steam. However, now investors believe that there could be actually bigger push toward the corporate reform, so that to make sure that the chaebol or the controlling family at these listed big conglomerates are not exercising outsized influence and treat shareholders on equal terms. One of the big reasons for that is that the opposition party is likely to emerge stronger after this political turmoil, and they have a greater and stronger reform agenda, including seeking a key legal change that a lot of investors are pushing for in order to have better corporate governance in South Korea.
Yeah, you've been on top of that story, well before, the greater market was conscious of it. This corporate value up program, and at the core of that really are these reforms, right? And what I want to understand is politicians in South Korea have been talking about reforms to the chaebol system for as long as I can remember. Are they still as powerful and influential, not just in markets, but also in South Korean society?
Yeah, you have a point. So there has been attempts to reform chaebol in the past before that has not been always successful. But I think this time things are a little different. One reason is that we have a huge retail investor base who are better organized, who are united, and they're often organized to start shareholder activism, sending letters to National Pension Fund and the companies involved. And we now have the shareholders and retail investors that the politicians and lawmakers cannot ignore. So one of the key changes that we see in the latest reform effort is that the retail investors and policymakers, as well as lawmakers, are joining forces to make sure that reform is at place. So we might be at the start of a really big sea change that's happening in the South Korean stock market because now the retail investors are becoming a force that politicians or lawmakers and policymakers cannot ignore anymore.
Yuking Lee, fantastic report, and to all our viewers and clients, I highly recommend, of course, checking the piece out of Yuking here. Subscribers can take a look at this in closer detail in today's Big Take. Of course, that's on the terminal. It's also on Bloomberg.com. Now, from one political drama to another in the region here, and this one is actually, I guess it depends where you are in the story here. It's equally dramatic, if you ask me. So you have reports, and we're talking about the Philippines now, saying that Vice President Duterte may not appear at the National Bureau of Investigations today. Now, she is, of course, due to be questioned over her apparent threats last month to have President Marcos assassinated. Now, if she, of course, and the condition there, if she herself is killed. Let's bring in Manny Serapio, our bureau chief over in Manila, to talk us through this. And Manny, well, get us up to speed. What's happened so far today there?
So for today, David, what's happened is she didn't show up. So this is the second time she skipped the questioning at the National Bureau of Investigation. And her lawyer showed up and spent a few minutes there to meet with the Investigation Bureau chief. And apparently the NBI chief is holding a briefing in a few minutes. So we'll be up to speed on what the next steps would be for this probe, because they couldn't get the Vice President herself to explain in person her apparent threat to, as he said, the threat last month that she made against President Marcos. But sorry, and as well. But the thing is, what's happening later this morning is the Vice President is meeting with media. This was something that her office has scheduled just last week to meet with media, which she says is over Thanksgiving, and probably we will get some comments from her over this probe as well as the 2 impeachment complaints that were filed against her at the House of Representatives.
Yeah, exactly on that point. Tell us more about those impeachment complaints and what's involved in them.
So the first one alleges bribery, corruption, and other crimes. That was filed last Monday. And then 2-3 days later, a second impeachment complaint was filed. This one is accusing her of betrayal of public trust, zeroing in mainly on her office's alleged misuse of about $10 million worth of public funds. There was a local media report shortly after that, a week after that, saying that she welcomes those complaints that were filed against her because it basically it spares her staff from the office of the Vice President, as well as her previous cabinet post, the Education Department, from getting involved in this complaints. And I guess she will face them head on. But the question is when. And also timing is quite crucial here, because up to now, the House as a plenary hasn't discussed these complaints, and they will be on recess, if I'm not mistaken, sometime next week. And so they don't have enough time this year, and probably not enough time again next year, because campaigning for the midterm elections starts in February.
All right, that was our Bloomberg Manila Bureau Chief there, Manny Serapio. Philippine stocks are just a little bit under pressure so far, but nothing too major just yet. Some of the other stories that we're tracking this morning as well, Bloomberg has learned that the Biden administration is weighing harsher sanctions against Russia's lucrative oil trade. That would be just weeks before Donald Trump returns to the White House. Sources say Biden's team may target some Russian oil exports as fears ease over a spike in energy costs. The outgoing administration has also moved to ramp up military and financial support to Ukraine as it prepares to depart. The suspect in the murder of the United Health Group CEO is fighting being sent to New York to face charges. That potentially sets up a very long legal process. Luigi Mangione faced a court hearing in Pennsylvania where he was arrested on gun and fake ID charges. His lawyers say the 26-year-old will contest any extradition request. The judge did deny Mangione bail and he will face court again on December 23. Doctors in Brazil say President Lula da Silva is awake and conscious after emergency brain surgery. Lula will stay in the intensive care unit for 48 hours as a precaution and should return to the capital early next week. The president's health issues come at a delicate political moment with a fiscal plan hanging in the balance. It's also sparked debate about the 79-year-old's fitness for office. We'll have plenty more ahead. This is Bloomberg.
We've had a lot of speculative issues this year. We have a little bit more certainty next year. So, half the world's population of the Western world went to the polls this year. We had this tiny election in November.
Tiny.
Tiny. We've got still some major conflicts raging. As we look through to 25, maybe we have some more certainty.
If you don't have a mindset of saying, how should we be thinking? How should an investment team think about AI? I don't know that nobody has the answer, but if you're not thinking about it, you're going to be left behind.
I've seen estimates of potentially $4 trillion in private credit going forward relative to where we are now. So we could see a doubling of the size. And I think one of the elements that would potentially drive that is a way for retail investors to somehow move into private credit, which right now that's really not happening. It's at the very beginning in some cases, but that will also drive that development and make it more, shall we say, the democratization, if you will, of private capital.
We are in the midst of the largest wealth transfer in history right at this very moment. So $100 trillion of wealth is going to next-gen and millennial clients over the next decade. So that has some pretty significant implications. But in addition to that, women are controlling more and more global wealth. Control a third of global wealth, but in the next 5 years, $30 trillion is going to pass in the hands of women, and they're going to control over 50% of the global wealth market out there today.
Well, they were just some of the world's top female executives speaking in London at the Bloomberg's first ever Women, Money and Power event, and really sort of pouring a little bit of cold water on, or casting doubts on, the economic impact of Trump's policies. But that is really the big question. Are they going to be enacted straight away? To what degree? And what is the inflationary result of those as well?
I mean, no one has the answer to that. I was listening into the RBA was this week, right? And even policymakers, central bankers, and we can't make this up, right? They basically say, this is what he said. We don't know what he's going to do and when he's going to do it. And it's a separate art altogether to extrapolate when the economic impact is going to show up, right? But I think what's been consistent is don't sleep on inflation coming back in the U.S. this time next year, is maybe just a splitting the difference model there. As far as the economic impact is concerned. Speaking of inflation, there's one read coming out today, 2.7%, that goes all the way down. Have a look at the estimates and have a look at where we're coming from as well. U.S. assets going into that, 6,000, of course, that handle. You have the yield curve. You have the U.S. dollar, of course, playing out. And, we don't have it. Oh, no, we do. No, we don't. What we do have, though, is some of the big movers. Chosun Tourism Group, 80% up. There's an offer, of course, to take it private.
Take private, yeah. from that company there, and also some placements we've seen as well from SenseTime, RoboSense Technology. They're both out to try and raise a bit of capital and try and expand their businesses. But that is it for the China show today. We will be having US Treasury Secretary Janet Yellen joining Bloomberg TV later today.